Focus on another company, Raymond. InCred, well, they have initiated coverage on Raymond with an ad rating and target price of 2,200 rupees per share. The brokerage believes that Raymond is well placed from a growth perspective led by changes in leadership. They also say the sale of the non-core FMCG portfolio at rich valuation, that's driven the company to move into the net debt-free status. Amit Agarwal, the group CFO at Raymond, joins us on the show. Hi, Amit. Good morning. Thanks so much for joining in. Well, the stock has done very, very well, so things get even more interesting from here on because the hopes are high. Give us a couple of details. How's the wedding season panned out? And also, you'll have festive season in the second half of this year. So are we bracing for a softish first half of the year, or are trends still looking up?
Thank you. No, it has been a very interesting journey for us. In the last 3 years, we have been able to achieve a lot of ground. And you see, with the FMCG transaction, we have become not only net debt free, rather we are sitting with more than 1,500 crore of cash with us for the growth of the business. Now, if I talk about the first quarter, you see the weddings, which we normally tend to see in the rural sector, especially in the summer season, has been little slow because of the 2 or 3 reasons, which we all are well aware that in the February and March, there were some rains which had impacted the crop. And that is why some of the people have been little bit less in the mode to spend money. Second thing, the heat wave which was there in most part, especially in the North India, also led the people to avoid weddings and shifted some of the weddings from the summer to winter. However, overall, if I look at it, some of the other categories have done decently well for us. So we are seeing a balanced quarter, and actually always the first quarter is always a slower quarter, seasonally weaker quarter. So to that extent, we feel quite satisfied in that quarter. But as you rightly pointed out, I think the second half looks very, very strong. I think people are expecting once again a very strong festival season, and our dealer franchisee network, they all are seeing that the festival season as well as the wedding season would be very, very good for us.
All right, Amit, you mentioned about the net cash position. I just want to ask you a couple of questions out there. You got to close to 2,800 crores for the FMCG business. Some of that would have gone in taxation. You've done some CSR activities, I believe, of around 50, 60 crores. Now, removing the debt from it as well, you have 1,500 crores. What do you do with this debt? And tell us, you'll be having 2 listed entities soon, right? Who gets this money? Which entity will sit? Because 1,500 crores of net cash is what you'll be having.
Yeah, so let me give you the full picture about that. So we sold the business for 2,825 crores. And after paying tax and everything, we are left with 2,200 crores. And if we see the demerger of the lifestyle business from Raymond Limited will go into that FMCG company, which will go along with a debt of close to 1,800 crores. So to that extent, 1,800 crore against the 2,200 crores. So you will have 400-500 crore based on the current position, cash in the lifestyle business in that FMCG company, and the balance 1,000+ crores we will have in the Raymond Limited, which is primarily the real estate business as well as the engineering business and the corporate, which we want to take it forward and grow some of the other businesses as well.
Okay. Amit, that's really helpful now that you have given us the breakup of the cash. So next logical question is, what are you going to do with the money? I mean, is there, will there be perhaps a bigger dividend, special dividend this time around? Anything else that you're planning? You also, of course, have, capex plans with your ethnic wear brand. So just give us a breakup. How much cash goes into the business? What part of the business? And if there's any other way in which you can reward your shareholders.
So look, as far as the money is going to be spent, we have chartered out a significant growth plan for the lifestyle business. As mentioned earlier also, we are opening in the next 3 to 4 years over 500 stores, especially the EBOs, in order to drive the growth. So that will be both for our apparel brands, be it Park Avenue, Raymond Ready to Wear, Color Plus, as well as ethnic stores. So that will be one, but most of it is a franchisee-led, so we are not putting a large capex out there. The large capex which we are planning to do is already in place, is close to 200 crores, which we are spending money on the garmenting business, the B2B for white label. As you know, the China Plus One is helping the country as well as us in a very large manner. We are expanding our capacity by 1/3 so that we can cater to the increased demand from both US and Europe. So that's again a large capex. And plus all our businesses are having a significant cash flow generations. So our idea will be to deploy this money because as you increase the revenue, there will be an increase in the working capital, not obviously the number of days. So this will be primarily used for the business in order to take it to much higher level and grow the lifestyle business, because we see a lot of opportunity in our home textile business. We see a great opportunity in the shirting business, which we want to expand. Third is the ethnics business, as we have begun opening stores. Last year, we opened almost 65 stores, and we also plan to open more than 100 stores in this year.
Okay, Amit, give us just a targeted revenue mix as well. I mean, you described all the businesses and you're deploying cash. So let's say between the apparel business where you're putting up fresh capacity and, home textiles, denim, if you sort of just break up the revenue pie in terms of what is your targeted pie for end FY24?
So look, end FY24, we are still considering that the lifestyle business, which is relating to fabrics, apparel, garmenting, that business will contribute close to 70% of the revenues, and the balance 30% of the revenues would come from the real estate as well as, engineering business.
Okay. All right, Amit, got that. Thank you very much for joining in and giving us a sense of how you're looking at things for the rest of the year. We look forward to more conversations as we go ahead.